be going up. And of course, as you look at the euro chart, you can see that yes, indeed, the euro did go up. We had a situation here, kind of where the move has sparked up. Now we have a situation where the market has slid a little bit sideways. Again, if you're using that criteria, as I mentioned before, of putting a stop below the predicted low, you can use a predicted low right here as a point of reference. And then if the market drops, in the case of the euro, because of its price, you might want to have it drop by a full cent, by like from 123 to 122 would be a full point, 100 pips. But you might want to have it drop below that and to get you short. So you likely could be short in the vicinity of around 121, somewhere right in there on the Europe, and that would be your current position today. Of course, at the same time, keeping a stop above this predicted high in case, excuse me, in case that market does turn around and reverse course. Now, the assumption that many people are making is that the euro is in a, some even question if it'll survive, in its current form, but that it is in a longer-term move and could come back to parity. Hard to say. All we know at this point is that the predicted differences have started to turn down. The crossover has been made to the downside. The Darrell index is at 0, and that was all going into the action on today, June 29th, and the euro did go down further today. If that's a long-term move and you're short, and you can get on board, or you have gotten on board somewhere in this time frame, great. That's what your intent is. But you probably, if you're looking at a trade of the last half of 2010, I would say that the prospects for a short euro position are probably the best. The one disconcerting factor in the whole thing is, of course, a lot of people think that way. And so when a lot of people think one way, what are the odds that it actually is going to unfold as everybody is thinking? Markets have a tendency to kind of do exactly the opposite of what everybody expects, and kick out the most people as it possibly can. So the euro can do anything, but at this point it looks to me like the euro, a short euro position, is one of the better trades, potential trades, for the last half of 2010. We're going to move now to the E-mini. Again, looking just at some of the same types of clues that we looked at before, where we were talking about where our points are on the E-mini. We are going to again use the predicted highs and predicted lows. I know today is this is again June 29th, a very sharp down day. So how far this down move might take, hard to say. But assuming that you have been using this type of strategy that we're talking about, remember, first of all, you probably would have been into a position somewhere right in there when it broke above the predicted high. And then as it moved up, did this little counter trend move that you see right here. The move went to the upside. Then you want to be prepared to go short, because the assumption is that once a longer-term primary trend is in place, it probably is going to resume at some point. In this case, with the E-mini, you have the predicted differences have turned down. You have had a crossover situation. The predicted medium-term difference has crossed below the predicted long-term difference. You have the Darrell index at 0. You have the downturn in the predicted moving average and the crossover below the actual moving average. All of these things coming together, indicating that you would like to be short the E-mini. Where would you be short? Again, using the predicted low. We're going to use this predicted low here. This for a couple of days ago here. I believe this was the one that was on June 21st at 1109. And I don't know what your criteria might be, but we're going to allow 10 points of leeway here in case the market is trying to fake us out or anything. So we would try to be short 10 points below the predicted low, which means we would be short at 1099 or somewhere right in the vicinity here around 1100. I probably do that line a little bit too high, but around 1099 you would be short, and of course you would be short with a position with a stop above the predicted high in case that market turns. So short the E-mini, and that looks like the route to go, at least for the short term. Now keep in mind, as I mentioned before, we also are going to be looking at the traditional technical analysis types of things, because lots of people do, and you want to know what other people are thinking and how they're viewing things. If that market drops below about 1045 or so, the market could slide back into the triple digits, into the 900s somewhere, and it could do so rather quickly, as we have seen some of the changes that we have seen in the stock indexes in recent days. But again, this is not saying that the E-mini is going to be lower all the way through the last half of 2010. I think probably only thing you can say is this is a short-term forecast, and the odds are, as you know, September, October could be kind of a little bit of a rough time, for the stock indexes if they follow the historical course. So, keep that type of thing in mind also. Gold, quick look at gold. Mentioned earlier that we do not have we have an uptrend, but we don't have maybe as blow off, bubble top, whatever you want to call it, in gold as potentially you could have. Again, you have to put the caveat yet. It could take off at any time. Also, quick look at the gold, and kind of swung back and forth. It has not really given any clear clues. We have had some slightly higher highs, but no real good clear clues for either the swing trader or the long-term position trader, other than a person who would like to hang on to a long-term position. There are a lot of people that are going to buy gold. They're going to stick with gold. So it's not like a real tradable type market, but it is a situation. The market is trending up. So if there's any question about where to go, you want to probably be on the long side of gold in the second half of 2010, and that means you're going to be wanting to be above those predicted highs, or the actual high if the market shoots above around 1265 and goes on to new highs. Just another sign that gold is still on the upward march, and that's the way you want to be if you're looking at gold. You always want to be in the direction of that primary trend. When you look at crude oil, crude oil is choppy. It's had its times. It's kind of one of those markets. We look at the highs that we have had over here and here. We've had two highs around $87 a barrel, kind of a double top type situation, before the market began to collapse. As after I don't know if it had any real connection to the BP oil situation, but anyway, it started to collapse in May, fell pretty dramatically, and has since come back. At this time, the trend is up, but as we always say, when you have an uptrend, you always want to look for that protection, that signal, that clue when it breaks the predicted low on the downside to take a position, because that could suggest a longer-term move that is just beginning and be a different direction. So with oil, again, if you are in the market today, it was down sharply. Would you have caught this move if you had a position below the predicted low? Probably. You might be sitting pretty, and that